In this video, I'm going to talk about 6 tips to help you save money on Healthcare.gov for 2020. Now, it doesn't matter if you're a W-2 employee or an independent contractor who's a small business owner. It doesn't matter. I'm going to show you a bunch of ways that you could save a ton of money on your health insurance. But before we do, if this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, Certified Financial Planner, helping you reach your financial goals. So I'm going to go over these 6 tips. Now, I don't see these tips being talked about enough at the value of you saving money on the Healthcare.gov website. But these are really simple ways that you should be looking at the Healthcare.gov website to make sure that you're paying the least amount and getting the right amount of coverage. Now, the first thing that you may or may not have heard of is the premium tax credit. It's talked about quite a bit as a way to reduce your premiums by getting a subsidy. But there's also another component. That is the cost sharing reduction. So there's really 2 parts to saving money with the Healthcare.gov website, the premium tax credit and the cost sharing reduction. So I'm going to talk about that cost sharing reduction for a moment. If your income is below a certain threshold, you might actually get an additional assistance by paying for things like copay or emergency cares. So I'm going to pull them up on the screen and show you 2 of the exact same plans. One applied to the subsidy, the cost reduction subsidy, and the other not applying the cost sharing subsidy. So I'm going to show you right now what it looks like if you have the cost sharing subsidy and what that plan looks like versus one without it. And they're actually the same plan. It's just one's a little bit cheaper than the other. And I'm going to show you how to navigate it as we move forward. So just follow along with us. I'm going to pull it up on the screen. So the first plan that we're looking here is one that's in my area. So this is a plan that I can actually personally qualify for myself and my family. Now, if you're looking at that premium, you're saying, wow, that's a really high premium. Remember, I have a family of 5 right now and soon to be a family of 6. So when we're taking a look at this, that number is only for a family of 5. So don't fall out of your seat if you're looking at this thinking, wow, all these premiums are really high. I'm just comparing these 2 plans. So this plan, what I want to bring your attention to is the middle of this page where we're looking at the emergency care. And we're looking at generic drugs. Generic drugs, $22. So it's a copay of $22 for primary care visits. That's $10. And for a specialist, it's $40. Now, this is with the cost sharing reduction applied. And that's based on your income. Now, if we quickly flip over to one that's the same exact plan, look at that. It's still the Blue Select Silver 1443, but all the costs are completely different. The emergency is a little bit higher at $650. The generic drugs jumps to $35. The primary goes up 13 times to $130. And then the specialists is almost triple at $110. So a little bit, I guess a little bit more than double. Now that is applying the cost sharing reduction. And you might be thinking, well, it doesn't matter. Like if I either qualify for it or I don't, right? Well, not exactly. So here's the first way that you can figure it out with the income levels and savings calculator. So just go ahead and enter in how many people are in your household and then go ahead and put what state you're in. So we're in the state of Florida, but obviously put your state and then put your income range. Now these income ranges are really important. So for a family of 5, that's what this is based on. And all these income thresholds will change based on your household size and where you live. So poverty line is that first level right there. So it's below $30,170. Now, a lot of this math is based on between 1 and 400% of that number. Now, that doesn't mean anything to you at this point. I'm just explaining what that is. So if we choose this and we say, okay, we're going to make below 120, but over 75, 425, we click submit, and it's going to say you qualify. Because if it's not above that top threshold of $120,680, then you're going to qualify for a family of 5 living in the state of Florida. Now, if you put it as a single individual, that number is going to, or that range is going to be completely different. As you can see, it's $12,490 or below is the poverty line of 100%. And it goes up to 400% at $49,960. Now, here's what's really important to understand about this math. It's not how much you're earning day one. So if you say, I have a job that pays me $50,000, what's really important to understand that your earnings, your revenue, your gross amount might be $50,000. But if you're saving into things like your 401k, it's lower than that. As far as this calculator is concerned and as far as qualifying for these dollars is concerned. So if you can get yourself below these thresholds by saving additional dollars or other strategies that I'm going to talk about in a minute, then you can reduce your taxable income first, and second, you can qualify for some of these subsidies or the cost sharing reduction plan. So here's what's really interesting about the cost sharing reduction and these estimates. It's based on an estimate. It's not based on what happened last year. It's based on what you think is going to happen moving forward. So yes, the W-2 income, that's set in stone for the most part. So that estimate is going to be entered in. But your 1099 or your contractor, which is contractor work, that is all subjective. We don't know if you're going to earn that amount of money. So if you're a YouTube creator, you drive for Uber or Lyft, or you have a short-term rental, that all fluctuates quite a bit. And if you're close to one of these thresholds, you should look a little closer so you make sure that you're getting your estimate correct. Now, what does that really mean? That means if you're above the estimate because you estimated that you were going to earn too much, and then all of a sudden you fall below that threshold, they're not going to go back and give you the difference between the higher plan and the lower plan on all those cost sharing deductibles. So you're not going to have any of that. That is not something that they're going to go back and give you the money back. And on the flip side, if you estimated too low and then you went and corrected it later on, you're not going to have to pay additional dollars into it. So you want to make sure that you're as accurate as possible, yes, but according to the Healthcare.gov website, and this is what it says. It says, just do your best to make a realistic estimate and be prepared to update it when it changes. It tells you right there. It's telling you just to do your best. So as you earn more money or as that money actually starts to come through, then you know you've made it. Go ahead and make that adjustment. So if at that point you're projected to make over that threshold of whatever that threshold was for your particular plan, for your particular area and your household size, all that information that goes into it, then you can make that adjustment. So what that means is tip number 3 is understand the difference between what I talked about before, your revenue, your gross, the amount that you earn, and the amount that's actually going to be taxable when it comes to, in this case, your modified adjusted gross income. But that is the amount of money that you're actually earning and not putting into retirement plans or expenses for a small business. So you want to understand the difference in those two. So if you're looking at some of these numbers and immediately saying, well, hey, I'm a family of 5 and I make $130,000, let's say. Well, if that's the case, by you saving an additional $10,000, you might qualify for more of the subsidies and the premium tax credits. So you want to take a little bit closer look to see what flexibility you have there. Understand the difference between revenue and income. Now, tip number 4, we've already said a few times, it's saving additional dollars into your 401k. But I want to point this out because it's talked about on so many other videos. The Roth IRA versus the 401k or 403b, TSP, any of the pre-tax accounts that you have. Everyone always talks about put it into the Roth IRA. It's going to grow tax-free. It's the best savings account possible for your future. It has all this flexibility in it, and that's great. But guess what? It doesn't reduce your overall tax liability. And this is a great example of why you would want to use the 401k in this instance to reduce your taxable income. Because this is more like a use it or lose it. Either you get the premium tax credit or you don't, or you get the cost sharing subsidy or you don't. So you really want to look proactively at what you can put into your retirement accounts to reduce your overall tax liability to qualify for some of these benefits because they're available to you. Tip number 5 is a little more technical, and that is Section 179. You might be thinking, whoa, Section 179, that's tax code. I don't know what that is. And you're running away. But it's huge if you understand how it works. For the 2017 Tax Cuts and Jobs Act, this is what happened. Section 179 was opened up so we can actually expense things like a camera. So if you're a YouTuber and you're going or thinking about going out and buying a camera, maybe this is a great time to look at where your income is going to fall. Are you going to make that purchase now or next year? Now, if you make it now, then you can Section 179 it, meaning you can take it as an expense and you don't have to spread out that cost over many years. What that does is it's going to reduce your overall income because it's a business expense. So you're helping reduce your taxable income. So if you're going through this and you're thinking, well, hey, I'm pretty close, so I'm going to anticipate buying some camera gear or buying some other assets that I can depreciate immediately, Section 179 could be a huge opportunity for you. And this goes with all different industries. It's just a matter of what the item is and whether or not you can actually apply it to Section 179. And tip number 6 is the easiest one of them all. Get a plan that works for you. The high deductible plans have high deductibles. So if something were to actually happen to you, you might be stuck with a huge hospital bill. So you really want to make sure that you're not just getting the cheapest plan. You want to get a plan that's appropriate for your lifestyle and everything that you're doing. And you have to ask yourself the question, what would happen if you ended up in the emergency room? Would you be able to cover those costs? Do you need to boost your cash reserve? Do you need to do something different in your financial life to make sure that you're protected? Because it could be a huge liability. Now, the lure of having an HSA type of account where you can save additional money pre-tax and you have this low premium might sound really great, but if something were to happen to you, it could be way more expensive than going with a little bit better coverage plan that has a little bit higher premium to it. So you really want to consider that. And that is how you can save a bunch of money on the Healthcare.gov website for 2020. So I hope you get the right plan at a reasonable price. And if you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.